Okay, Aiden, riddle me this. What's confusing, invisible, and makes traders sweat more than earnings week?
That could describe a few things, Claire. But I'm guessing, given the topic of this podcast, implied volatility?
Bingo. Or as I called it when I was first learning. That scary number next to the option strike price I want to buy.
To be fair, IV is supposed to scare you a little. That's kind of its job.
And IV rank? That's like, is it scary for you, or just scary in general?
Exactly. It tells you how today's volatility compares to the past years. So you're not just reacting, you're actually measuring.
And that brings us to today's guest article. Dr. Scott Brown breaking down IV rank and IV percentile in a way that even I can understand. Mostly.
You understood it. You just renamed it. Vibe score for options.
It is kind of a vibe check though, isn't it? Let's be real. So grab your notebook or your vibe crystals and let's get into it.
Okay, so if you've spent any time at all looking at options trading, you hear it constantly, right? Implied volatility is high, or IV is low.
Yeah, all the time.
But here's the real question, the one that actually matters.
Yeah.
Compared to what? You get this raw percentage, but what does it, really tell you about your trade?
That's the crux of it. Taken alone, those raw IV numbers, they're almost meaningless. It's kind of like saying it's hot.
Right.
Well, okay, but are we talking Phoenix in July or Seattle in July? That context changes everything about what hot means.
That's a great analogy. And it plays out exactly like that in trading. We saw this great example in our source material. Let's say someone mentions Tesla, TSLA, has an IV of 75%.
Yeah, 75%. Sounds pretty big.
Yeah, exactly. For a lot of people, that just screams volatile. 75% feels really high. But if you know that Tesla's typical IV range is actually, say, between 50% and 100%.
Then 75% is, well, it's just kind of average for Tesla. Right in the middle. Nothing too crazy for that stock.
Exactly. It's not exceptional at all. Now, flip that. Take something like Microsoft, MSFT. You see MSFT with a 40% IV.
Okay. Seems much calmer, almost boring, maybe.
Right. Seems tame. But what if Microsoft's usual historical range is, let's say, somewhere between 20% and 45%?
Okay. Then 40% within that range.
Suddenly, 40% is actually extremely high for Microsoft. That context just completely flips your perspective.
It really does. Those raw numbers without the backstory, they can easily fool you, lead you down the wrong path entirely.
And that's exactly the problem we want to tackle in this deep dive. We're here to introduce you to what our source calls the missing link.
Which is?
IV rank and 4 percentile. Now, these might sound technical, but they're actually pretty simple, really powerful tools that give you that crucial context.
Mm-hmm.
Once you get a handle on them, you'll know when volatility is truly high or low for any specific stock.
Yeah.
And that gives you the confidence, to decide, should I be selling premium here or buying it? And you can tailor your trades properly based on real conditions, not just guesswork.
And a lot of the insights we're discussing today, they come from the work of Dr. Scott Brown. He's a finance professor, writes for Pitt News Magazine, and he does a great job breaking this stuff down.
Okay, so we've established raw IV numbers alone. Not enough.
Yeah.
Let's dig into the solution then. People hear IV rank, and maybe they think it's some, complex formula. Can you simplify it? What is IV rank fundamentally, and why is it so useful?
Yeah, absolutely. At its heart, IV rank isn't really about complicated math. It's more about normalization, perspective.
Normalization, how so?
It takes the stock's current implied volatility, right? And it basically plots it on a map of its own history, specifically where does it sit compared to its highest high and lowest low over the last year, the past 52 weeks.
Correct.
Then it expresses that position as a simple percentage from 0% to 100%. So 0% means IV is at its 52-week low, 100% means it's at its 52-week high.
Got it.
The real power isn't memorizing a calculation. It's what it tells you instantly. It lets you compare a stock's current volatility to itself historically, an apples-to-apples comparison. It cuts through all that noise from just looking at raw percentages across different stocks.
So if I see an IV rank of, say, 80%, that tells me the current volatility is way up there, near the top end of where it's been for this specific stock over the last year.
Exactly. 80% means it's higher than it has been 80% of the time over the past year, within that high-low range.
And conversely, if it's maybe 20%, it's pretty low compared to its recent history.
Yeah.
That standardization seems incredibly helpful.
It is. Let's use a quick example. Say a stock's current IV is 60%. Sounds maybe high, maybe not. But let's say its 52-week IV range was between 30% and 90%.
Okay, range is 60 points there.
Right, so the current 60% is exactly halfway between the low of 30% and the high of 90%. Its IV rank would be 50%.
Oh, okay, so 50% IV rank tells you immediately this stock's volatility is right smack in the middle of its typical range for the past year.
Precisely. It's a clean, normalized snapshot. Very easy to interpret.
Okay, that makes sense. For IV rank, it tells us where we are in the high-low range. But then there's also IV percentile. How is that different? Does it give us another angle?
It does. It's a slightly different perspective, but complementary. 5e percentile doesn't look at the high-low range itself. Instead, it asks, on what percentage of days in the past year has the implied volatility been lower than it is right now?
Oh, interesting. So it's about frequency.
Exactly, frequency. So if a stock has an IV percentile of, say, 90%, it means that on 90% of the trading days over the last year, the IV was actually lower than what you're seeing today.
So a high IV percentile suggests the current level is consistently high compared to most of the previous year.
Yes, it tells you how often IV has been below the current level. It gives you a sense of how unusual or sustained the current volatility level is compared to recent history. It's about the frequency of lower readings.
Okay, I think I get the distinction. IV rank. Where are we within the 52-week high-low range? 5e percentile. How often have we been below this current level in the past year? That's a subtle but potentially powerful difference for a trader.
It is. And Dr. Brown, in his work, actually suggests using both.
Oh, really? How does he recommend using them together?
He often uses 5e rank for the primary decision, like, is this a situation where I generally want to be selling premium or buying premium?
Okay, the initial strategic direction.
Right. Then he might look at IV percentile as sort of a confirmation, or for additional context. Does the percentile support the rank's reading? Does it give a fuller picture of the volatility environment?
That makes sense. Use one for the main signal, the other for confirmation.
Yeah.
Okay, this is where it gets really practical. How does knowing the IV rank and maybe the percentile translate into actual trading strategies? What should you do with this information?
Well, the framework that comes out of this is actually quite straightforward, but really effective. Basically, if the IV rank for a stock is high, let's say, generally above 50% or maybe 60%.
So volatility is elevated compared to its own history.
Exactly. In those scenarios, the general approach is to look for opportunities to sell premium.
Why sell?
Because when implied volatility is high, the options themselves, both puts and calls, tend to be more expensive. They carry a higher premium. So as a seller, you're getting paid more for taking on that risk. It's like selling insurance when the perceived risk is high.
Okay, high IV rank, look to sell premium. Makes sense. What about the opposite if the IV rank is low?
If it's low, say below 30% or 40%, that means IV is currently kind of depressed relative to where it normally trades for that stock.
Options are cheaper then.
Comparatively cheaper, yes. So that's generally a better time to be looking to buy premium. If you want to buy calls or puts or maybe debit spreads, low IV rank environments can be more advantageous.
Right, you're getting potentially more bang for your buck as a buyer.
Potentially, yes. And then what about the middle ground? If IV rank is somewhere in the middle, not particularly high or low.
Yeah, say between 40% and 60%.
That's often where you might consider more balanced strategies, things like maybe iron condors or other creative spread structures that aren't strictly betting on volatility going up or down, but maybe staying in a range or having a more neutral volatility bias.
This framework really clicks when you apply it back to those first examples.
Yeah.
Tesla, right? Raw 4 of 75%, but its 52-week range was 100%.
Which gave it an IV rank of 50% right in the middle.
So based on this framework, an IV rank of 50% is middle ground. You might sell premium, but maybe cautiously, not aggressively.
Exactly. It's not screaming sell premium like a super high IV rank would. You'd likely be more measured, maybe size the trade smaller or use a wider spread perhaps.
Okay, now Microsoft, raw 4 of 40% seemed low initially, but its range was 20-45%.
Making its 4V rank. Let's see, 40 is 20 points above the low of 20. The total range is 25 points, 45-20. So 20-25, that's an 80% IV rank.
80%, that's high.
Very high for Microsoft. So the framework says, high IV rank. Look to sell premium. This looks like a much better candidate for selling credit spreads or maybe iron condors than the Tesla example, even though Tesla's raw 5e number was much higher.
Wow. Yeah, that simple layer of context, the IV rank, it completely changes the strategic implication of those raw numbers.
Absolutely transforms it.
It really does turn raw data into, well, actionable trade ideas. And I imagine understanding this context doesn't just stop at buy or sell premium here, right?
No.
More advanced traders must leverage this in other ways, too.
Oh, absolutely. Think about earnings season. Everyone knows implied volatility tends to get jacked up right before a company reports earnings.
The uncertainty premium.
Exactly.
Yeah.
And then, very often, right after the announcement, even if the stock doesn't move dramatically, that IV just collapses. It's called IV crash. So, if you see a stock with a really high IV rank heading into its earnings release, you can specifically design strategies to profit from that expected drop in volatility. Selling premium, maybe an iron condor, or even more direct short volatility plays. Knowing the 5E context gives you that edge.
So you're anticipating specific market events, like earnings, and using IV rank to position for the volatility shift around them.
Precisely. It also helps hugely with risk management.
How so?
Well, when implied volatility is low, options are relatively cheap, right?
Yeah, we established that.
So if your IV rank is low across the board, or for specific stocks you own, that might be a more cost-effective time to buy protection for your portfolio. Buying protective puts, for instance, or maybe structuring collars. Hedging is cheaper when 5E is low.
Ah, so it helps you time your hedges more effectively.
Definitely. And beyond individual trades or hedging, implied volatility itself, especially broad market 4 like the VIX, acts as a sort of market sentiment gauge.
The fear index.
Kind of, yeah. Generally, rising IV suggests increasing fear or uncertainty among investors. Falling forth can sometimes signal complacency or confidence. Watching the IV rank of the overall market can give you a pulse check on collective investor psychology.
That's fascinating. Okay, so wrapping this up then. For everyone listening, what's the single most important thing to take away from this deep dive?
If you remember just one thing, make it this. Stop looking at raw. Implied. Volatility. Numbers. In. Isolation.
Okay, message received.
Context. Context. That's everything. Understanding where the current IV sits within its own historical range, using tools like IV rank, that is absolutely crucial.
And just to hammer home that core strategy framework again, high 5V rank,
Generally, you're looking to sell premium.
low IV rank,
Generally, you're looking to buy premium.
and that mid-range high V rank.
That's where you consider those more balanced, maybe creative spread structures, neutral volatility plays. Look, trading is so much about understanding probabilities and context. IV rank is one of the best tools out there for giving you that essential volatility context. It helps you move beyond gut feelings about raw numbers and trade with more clarity, more confidence.
It really seems like mastering this one tool, IV rank, can help you trade smarter and, quite possibly more profitably than a lot of retail traders out there. It turns basic data into genuinely actionable setups.
It's all about using the information that's readily available to make informed probability-based decisions, moving away from guesswork towards a more strategic approach.
Absolutely. So here's something for you to think about now that you hopefully have a better handle on IV rank. Take a look at your own portfolio or stocks you follow. What historical volatility range will you analyze first? Where might you uncover some hidden trading opportunities or risks that you might have missed before just looking at the raw numbers?
Okay, I think I get it now. IV rank isn't just a number. It's like a market mood ring charted on a scale.
It's really very simple, Claire. High IV rank means higher premiums. That's basically it. People try to make it harder than it is.
But also higher risk too, right? Because you're not just selling an option. You're selling a parachute right before a potential cliff.
That's a very poetic way to say manage your risk.
Thank you. I write for a living now, apparently. Okay. If you want to understand IV better, re-listen to this episode, read the article from Pitt News magazine, and maybe, I don't know, tattoo the formula on your arm?
Or just bookmark the IV rank calculator.
Anyway, big thanks to Dr. Scott Brown for giving us a map to navigate the fog. You can find Doc Brown on the web at scottbrownphd.com or at pittnews.com. And if any of this goes over your head,
I know. Blame Mr. Turner.
See you next time.